Okay, welcome to our fourth quarter update for commercial. We had an exciting fourth quarter. We added over 20,000 square feet of occupancy across multiple different tenant types. It is our 8th quarter in a row where we have grown occupancy, added positive leases throughout our portfolio. Not only are we adding square footage, we also had over 20 of our tenants renew this quarter. We had 2 that vacated, but our net was over 35,000 square feet of positive retention in our leases. So we're very excited about those numbers. The one tenant that did leave, it was a medical tenant. It was a United Healthcare group, and we actually already backfilled that space. So we were excited to see how quickly we were able to turn over that tenant and that lease right there when we did have a vacancy that we saw coming up. Now, when we think about the types of assets that we're doing, I want to go into how the different types of tenants are performing. We really have 2 types. We have our medical type tenants, and then we have what we lump into kind of this general office tenants. So going into the medical side first, this is a space where we signed we signed about 5 leases this quarter of those 14 that we did in aggregate, and we have very few pre-ready medical spaces that are left. We only have 1 suite in our entire footprint that is left in the medical space. Now, a medical tenant is typically spending a little bit more on their TI, so we're offering packages right now that are between like $20 and $30 a square foot for TI. So if you have a 2,000 square foot medical tenant, it's somewhere around a little over $40,000 that we're contributing into that lease to do the interior build out. They've got to be a little bit nicer for what they are doing. Most of these tenants then are signing 5 to 7 year leases, and we're also seeing 3 to 4% rental rate escalations on those leases. So medical, yes, we're going to spend a little bit more up front. We're getting longer leases out of it, and we also get a little bit higher rental rate because of that. On the commercial side, or general office side, we're seeing typically 3 to 5 year leases. A lot of the times, we don't have to put any TI in, sometimes maybe up to $10. But we're also seeing 3 to 4% rental rate escalations in that segment. Another trend that we're seeing within our leasing is our general office. We're seeing medical tenants taking some of that space. And it's in between medical and general office, but we have home healthcare services that are using general office space. We also have specialty education centers that can use what was a normal commercial office. And another segment that we signed 2 leases on this past quarter is mental health care. We had 2 franchise operations that opened their doors within our commercial space, and they took a general office that they're able to use for their services, and they also signed longer leases with that. So overall, it's been exceedingly positive on the rental rate side, on the occupancy side. Things are performing pretty well. Now, when we think about office as a whole, I know there's a lot of probably not optimistic news out there. I think post-COVID, everyone's opinion of how they work, where they work, or what they're going to be doing, while we might not all agree, we can certainly say that most people's opinions have changed. And when we're looking at our footprint and what we buy, we look at the Placer AI data that shows us foot traffic. We look at what do people want to be doing. And the trend right now is people are not super interested about going to large downtown high-rises, especially if they live in suburban markets. It's different if you live in the city and you're walking or you're very close or you have public transportation. But in the South, most of our assets here, we're between Atlanta and Charlotte. That is not what our typical tenant is. And most of our tenants, we have all suburban locations, are close to their house. It's easy to get to a suburban office center that has plenty of parking. And then it's a whole lot cheaper. Our average rents are in the teens, whereas a lot of the downtown or higher multi-story stuff is $40, $50 a square foot. And the demand and the desire to be in those locations right now just isn't there. So that's why we think over the past 2 years, we've seen a lot of leasing momentum into the commercial offices that we own. We're actively looking to acquire more. And we are trying to find opportunities where we can get a single story or two-story brick garden style building that's close to a lot of housing and there's density around it, and limited new stuff can be built right there. That's perfect for us. That's exactly what we're looking for. We would love to see 20, 30% vacancy so we can come in with our leasing team and lease up that space, get the higher rental rates, get the lease escalations built in, so we're getting 3-4% every year. That right there is a perfect deal for us, and we think right now that there are good opportunities to buy at lower bases comparatively in the market. There's less demand, and there's kind of some headwinds when you think about office as the whole segment. So that makes there some pretty good buying opportunities for us and what we're looking for. Like I was saying, we're very different than a downtown tower, and that's not what we're looking to do. But the suburban low-rise, we see a lot of opportunity in the near future. When we think about our performance and how are we doing from a cash flow-wise and ultimately distributions, that's where we want to get to. When we're buying a deal that is 60 or 70% occupied, it takes us a little bit of time to lease that up. A good example is a deal we purchased here in Atlanta called Johnson Square. We purchased this at 64% occupancy. It was at 64% when we went under contract. We closed around 68%. And as of this quarter, we're up to 94%. We're making a distribution here, and it's performing well. That takes a little bit of time to get there. It's not like an apartment. You don't have the instantaneous bumps of occupancy. But once we are there, again, we have 3 to 5 year leases with the majority of our tenants. Also another location that we've seen some medical tenants move into with those longer 5 and 7 year leases. From an acquisition standpoint, if we can find them in that 70% occupancy range, it gives us a good basis of price because we're paying for a cap rate on 70% occupied, not on 95% occupancy. And it allows us to get bank financing that's out there. Right now, we have some of our new acquisitions that we're working on that we can get debt around 5.8 to 6%. We saw some of those come back in. We are, obviously the debt rates have been going up, and we've kind of been looking at like how high do they go each quarter, but even at a 6% rate with the price point and revenues that we can buy in place, the deals work, and especially as we lease them up and get to the 90+% occupancy range. From a distribution standpoint, the majority of our commercial deals are at that higher occupancy level, and they are making distributions this quarter. We have 2 deals that we are looking to exit. They're under LOI and contract right now. We're going to have more details out in the specific investor reports on those, on what we're looking to do. One of our fully vacant spec spaces that we built up in Charlotte, we are under contract there to exit. We'll have more details in our investor report on that one. As a reminder, all of your investor reports can be found in the Documents tab in our investor portal. Everything that shows up in the activity part, that will have all your links for each distribution that you receive. Please let us know if you have any questions. We're excited about the commercial office spaces that are available right now. We really like the fact that it's kind of the less talked about segment, and we feel like we can get some good basis and some good buys in the market right now. Thanks a lot. For more tips on operating and investing in real estate, please check us out at greenleafmanagement.com or find us on YouTube and Spotify.